Quick update on the timeline for economic data because it's about to completely flip again. We might get an end to the 43-day government shutdown as early as tonight, depending on how the House vote goes, whether or not Trump signs the package. None of that's guaranteed, but this is the first real shot at reopening here. And that matters because the Fed, they need to get back to work. They got to get this ball rolling because they're about to walk into this December 9th and 10th meeting to announce what they're going to do with rates. And right now, with the government closed, they're not getting 7 essential pieces of data that they use to decide that on. But now reports say that either way, whether they stay closed or they open, some of that data they're not going to get either way. And I'll talk about what I mean about that here in just a bit. But we just got to see what happens. Because if the Fed can't see the economy, which it appears that way regardless, how do they decide what they're going to do with the rates? So that's what we're going to talk about today. We'll talk about everything that dropped, the data timelines, the labor market cracks, this Fed drama going on, what markets think, and what should we expect heading into December. So the government shutdown is on its day 43. It's record setting. We might even go into day 44. It just depends on what's going on right now. The House is meeting here in just a bit to take votes. This will be between 5:10 p.m. and 7:15 Eastern time. If the compromise bill passes, it goes to Trump, and then agencies will begin to reopen if he does decide to sign. The bill is made up of some parts that funds parts of the government through January 30th, other parts for the full year, reverses some of these mass layoffs, and ensures federal workers receive back pay. But we got a slight nuance because air traffic and data, that won't go back to normal just overnight. Airlines say they'll need days to reassign crews. The FAA will need some time to lift these travel restrictions, and air traffic controllers, they still have to show up before back pay even arrives. So it's a weird time for sure with everything going on. And now for markets, the biggest domino is this. Delayed economic data will finally begin to be released, but it'll be done so very slowly. And we already covered Morgan Stanley's modeled timeline, assuming reopening this week happens. We might see November 19th, September jobs report, maybe on November 6th, September retail sales and PPI, December 5th, third quarter GDP, December 8th, that jobs report. And this is all before the Fed, so they'll be able to consider this in their December 10th meeting. After the Fed, December 18th, October PPI, and October Consumer Price Index. But we got some huge changes that were announced today, and this was pretty huge. So today, Carolyn Levitt stated that the October CPI and October jobs data are likely never coming out, which opens such a huge can of worms and so many questions because now, even if the government does reopen, even if they do reopen, the Fed is still going into their December meeting with estimates, partial data, guesswork, just way more of it. And all right, follow me. Let's talk about the labor market. And this is where the pressure's really building. So Goldman Sachs, they estimate that October payrolls, let me put this on screen for you. They estimate that October payrolls shrank by 50,000 jobs. That would be the biggest drop since late 2020. The reason why is that Goldman cites that there's these 3 things they're worried they're worried about, and their job growth tracker fell from 85,000 to 50,000. The government's deferred resignation program likely cut 100,000 payrolls, and layoffs and job openings are weakening. And ADP backed this up. Their monthly print, it looked pretty fine at that ad of 42,000 jobs, but now we know that growth was front-loaded, and the back half of October basically rolled over, and this is the exact type of decline the Fed needs the data to confirm on. But October data is probably lost forever, which brings us to September's report on November 19th. That was scheduled earlier than the October jobs report anyways, but I thought a lot of people kind of blow it over because we're so far in the past. yeah, that happened in September, but what happened in October? Now we're not even getting October. So this may now be one of the most important labor reports we've had in years. Economists are all over the board here. Call Sheet sees an addition of 46,000 jobs. Revelio 38,000 to 60,000. Reuters consensus unemployment stays at 4.3%. And then all these other data, this alternative data, they see sharp weakness in sectors like restaurants, healthcare, and tech, all of those showing contraction. And an indicator to watch, which is for layoff prep signals, would be HR hiring. And what the data is showing is that HR hiring is surging. Some of that data is showing this right now. And consumer spending pullbacks and dining out, plus delayed medical care, and then the shutdown effect. We're just now getting to that with the delays and uncertainty that hit hiring for some of these companies. So a ton of people expect this report to be bad, and I don't really blame them here. And a downside miss on this November 19th could really put the Fed in this weird corner, because now they're not getting any October data, plus weak September report, and that would just lead pressure to cut. And all of this is in my own opinion, and I could be completely wrong, because today we got probably one of the most hawkish pushes we've seen in weeks. This comes from Susan Collins. She's at the Boston Fed, and what she told us is that there's this high bar for further easing. She says that rates are mildly restrictive at this 3.75 to 4% range. So there's not much need to move them down, at least right now. And she's worried that cutting rates again risks stalling progress that the Fed has had on inflation, reaching towards their goal. She thinks cutting will reverse that completely and inflation will drift further away from their target range. And because of that, Collins won't support cuts without notable labor market downside. Her comments dropped the December cut odds for the CME Fed Watch tool down to 60.1%, and we could possibly see this number keep drifting down, probably closer to 50% leading up to the Fed's meeting. And then there's this Fed's three big divides. So these officials are mainly split on this, and these are some of the wonders that they have that'll help them decide whether or not they do cut rates come December 10th. And the first will be whether tariff-induced prices are this one-off, or will it be sticky towards 2026? That'll be one question. Is inflation sticky or not? And some members see that being the case, some don't. And without the data, it's kind of hard to see that. The second thing is the slowdown in hiring demand, is the slowdown in hiring demand driven or immigration driven? And the third, are rates restrictive or already at neutral? And depending on which camp a Fed official is in, they're either worried about recession or they're worried about reflation, or they're completely worried about making a mistake because of the data blackout, because they can't see. So this is the most divided the Fed has been since 2019. Then we got an announcement of somebody just retiring. They're sick and tired of everything going on. He didn't say that, but Raphael Bostic announced retiring in February's end. He's been more hawkish lately. He's been hawking for sure. So he's seeing inflation risks rising, and especially down the road. So this could open up room for a Dove to replace him and take his place and support further cuts down the road. But so far, what we've seen from all the news today, the way this impacted the market and equities is that it led them to rally on these shutdown optimisms. The Dow, which gained 0.68% on the day, its second straight record close, it gained green today, win the day. The S&P 500 almost flat, up 0.06%, and the NASDAQ, it fell today 0.26%. This is textbook flight to safety behavior. The Dow is where people hide when tech gets wobbly. It's mostly made up of industrials, energy companies, healthcare, financials, and it has less sensitivity to rate cut optimism and more stability when macro gets really messy. It's made up of these value plays. It's considered your, like I said, safe haven in a way. as far as stocks go, because then there's like gold and treasuries, but as far as equities go. So the Dow performs well post shutdown, and stocks and gold both rise about 60% of the time in the month after the shutdown ends. Also, November and December are historically the strongest 2-month stretch for stocks. The Dow has risen 77% of the time during the Santa rally window, with an average gain of 1.44% versus the 0.16% for all of the other periods of the year. And Goldman also found that in the first week of November, if that's down, the rest of the year tends to be positive, up 3.6% for the S&P, up 1.8% for the NASDAQ 100, and that aligns with the optimism we're seeing today. So we shall see where we're headed. And before we wrap up today, if you didn't know, today is the final day. Today, the U.S. mint its final 5 pennies, ending 232 years of penny production. It costs 3.7 cents to make 1 penny, so ending it saves taxpayers $56 million per year. So they wanted to get rid of it. I'd imagine a lot of people is going to begin auctioning off these pennies, and who knows if they gain value or not. So to close out today, we almost with no October data coming, the November 19th September jobs report becomes the catalyst before the Fed's December 9th and 10th meeting, and then it's just guesswork. If it prints weak, I think they lean towards cutting. But if it comes in strong, I mean, they kind of got a green light to just sit tight and play defense and just wait longer. We really won't know until the numbers actually hit, and even then revisions could tell a completely different story than what we get. So we'll just keep on watching, everybody. As always, I'll just keep you posted with whatever happens. You have a good one.